All right, so warm greetings, leadership. Welcome to your first session for FAC 1503 in the 2024 academic year, first semester thereof. So what I would like to begin with as we get started in this engagement, I would like to first start off by giving you an outline of the essential topics of note that you would be you'll be dealing with. Of course, there is certain changes here and there that have taken place with regards to some of the topics. One which I may, which I'm gonna indicate, but at the very end of the outline, right? So, but the first key topic in this module, it's actually dealing with topic 1 on introduction to accounting. Now, this particular topic, essentially, it's actually a theoretical topic. It's purely theoretical in nature, in the sense that what they deal with there, it's mainly the definition of accounting, basic principles and standards of accounting. So all those things are really purely theoretical, in nature. And those are things that you can even do a self-study on, just so that you can gain a bit of insight on what accounting is and likes, right? But I'm going to take you through that on a separate note altogether, because I want to deal with things that are heavily tested, mostly when it comes to the assignments. So as you already know, that when it comes to FAC 1503, it's a module arrangement, module setup, meaning to say that there is no examination in this module. However, each one of the assignments that you'll be doing, they all contribute towards your final mark that you get on your transcript. So it's very important that you have a good understanding of the content that would be explained within this module, and obviously be in a position where whenever they bring an assignment, you have got an understanding of what is being tested and how to approach the assignments in that regard, right? So you discover that after a certain, let's say for instance, after the first 2 or 3 learning units, they bring you maybe, for example, assignment 1, right? And then maybe after 2 or 3 other learning units, they'll also then maybe bring another assignment altogether, which will be in that case assignment number 2. So it's always important to be abreast with regards to the concepts that are dealt with in this module, right? So as you know, this accounting for lawyers or for law students, so to speak, it's slightly different to your other normal accounting that we deal with, especially with students that are doing purely accounting sciences. So with yours, as an attorney or as a lawyer in that regard, there is aspects pertaining to an attorney practice that you'll be dealing with as you progress further in the module, right? Topic 2 deals with basic accounting equation and the basics of accounting. Now, this is like the heart of the module, in the sense that you cannot have a good understanding of any of these other topics that we're going to talk about unless your background for topic 2 is cemented. In topic 2, I think that's also where they would introduce you to the inventory system. So there's another topic that had been added from 2021. Actually, they added another topic, but it goes together with topic 2 or topic 3 there, which deals with inventory systems. I may not have outlined it here, but it goes hand in hand. So it's important to get it right from topic number 2 to have a good understanding of the rest of the other topics. So what you discover when we get to topic 2, which is what I'm going to introduce you to today, we will deal with what we call the elements of the financial statements. And there are about 5 of those elements to the financial statements, namely assets, drawings, expenses, liabilities, equity, and incomes. Actually, it's 6, sorry. So there's about 6 essential elements to the financial statements, which you need to know. So what I'll be discussing as we get into the details of things, we'll be discussing, for instance, the nature of the element of the financial statements. How does it affect, the financial statements? How do we account for, cases where a transaction pertains to an acquisition of an asset, for example? How do we account for a transaction where maybe there's a selling or a disposal of an asset item in a particular transaction? How do we account for that on the basic accounting equation? Because you would get questions in your assignment where they would actually ask you, to reflect the effect of certain transactions to the basic accounting equation on the basis of these elements. So it's important that you have a good understanding of understanding or being able to pick up in a transaction what nature of an element to the financial statements are they dealing with. Can it be an asset that maybe they're addressing in a particular transaction, or is it that perhaps they're dealing with an expense in the transaction, or maybe something else, or any of those elements to the financial statements thereof. So it's very important. So what I'm going to be teaching you as we get into topic 2, I'll be dealing with the details of understanding the elements themselves, their nature, and being able to pick them up when you read a transaction. So you should be in a position that when you read a transaction, you can easily pick up that, okay, here definitely there's a transaction pertaining to an asset, or perhaps this one it actually deals with an income or equity, liability, or even an expense there, right? So I will teach you to be capacitated enough to pick up those elements as you read through the transactions in a context of a question, right? So now, what is this basic accounting equation that we're referring to? So your basic accounting equation, it can be reflected as assets equals to equity plus liabilities. So that's how they'll normally portray it in the context of a question. So it will be like, okay, you need to show the reflection of a transaction as to how it affects, for instance, the asset element, how it affects the equity element, and how it affects the liability element. Most of these things would make sense, especially if I get to do practical questions with you, so that you can at least gain some insight as to how this whole thing really operates, right? So that's what we'll be dealing with when we get to topic 2, basic accounting equation and the basics of accounting. It's very important because this is the foundation when it comes to this particular module. And like I said, in topic 3, like especially in the most recent one, you'll be dealing with inventory systems, right? So they deal with inventory systems, and in topic 4, that's where they of course touch about VAT. So there's just that slight adjustment. I just not yet accounted for it in my outline, but it's one of those that I can do, and then I'll send you the updated version thereof, right? But anyways, VAT, and I'm going to talk about inventory systems as a separate one altogether later. But you need to understand that in any practice, any fraternity, right, whether it's a law fraternity or legal fraternity as they call it, or whether it's a medical fraternity, engineering fraternity, there is VAT effects when it comes to transactions that they perform. So think about it in the context of you as an attorney offering services to a client, right? There are certain transactions that you would perform where you would need to take into account the effects of value-added tax. So what you will be dealing with in topic number 3, we'll be looking at the basic theories behind the concept of value-added tax. We will look at the different types of VAT supplies that you as an attorney practice would need to take into account, depending, of course, on the type of a transaction you're looking at, right? So there's what we call exempt supplies, there's what we call standard rated supplies, and then, of course, zero rated supplies. I'm going to explain to you in detail what does it mean when you're saying exempt supply, standard rated supply, zero rated supply. Then, of course, you'll be expected to do some recording of transactions in the books, in your books, obviously, as an attorney, and this we call journals and ledger accounts, right? So but of course, like I mentioned earlier, there's some theoretical background or principles that you need to understand that governs the principle of value added tax, which I'm going to be explaining as we proceed further, right? Then, of course, but this will be your topic 5 in your most recent tutorial letters, right? So they introduce you to what we call books of prime entry. Books of prime entry, right? With the books of prime entry, this is where I'll be teaching you how to record the transactions in the relevant records, right? So like I mentioned, excuse me, earlier, that with every business organization, regardless of fraternity or practice that the business is actually running, there will be need for them to capture or to record, their business transactions in their accounting records. So the books that we use, or the records that we use to record or to capture those transactions, we call them journals, all right, or books of prime entry. So there are several types of books of prime entry that a business practice could use. So in the context of you as an attorney practice, there are specific ones relevant and applicable to your business operation. And that would include things like, for example, your business cash book, which is your business cash receipts journal, business cash payments journal, and then of course you also be running a trust account, right, where clients will be depositing their monies before you can actually begin to perform their cases. So with regards to that, there is certain records that you need to maintain in form of trust cash receipts journal, trust cash payment journal, and of course a trust journal. So all these books that I'm mentioning, you need to be able to disseminate between the two different accounts. Because, for example, you'd have your own business account, your normal business account as an attorney practice, right? And with regards to this one, this is where your business funds gets into. And when I'm saying business funds, yeah, I'm referring to, the monies that are that you can then use for paying off business related expenses such as rental expenses, salaries and wages for your employees, telephone expenses, and all of that. So it's mostly associated with payments concerning business related costs. Whereas with the trust account or the trust bank here, it's mostly used to to account for trust monies that is coming from your clients, right, which you will use when you are now dealing with their case, right? The only time you would move money from your trust account to your business account, obviously, that is when you already began with the case. And this happens on a month-to-month basis. Because why am I saying that? Because some cases that you would come across as an attorney, they might go on for months. Think, okay, I may not necessarily, I do not want to mention names, but this is a public figure that you already know, and the case is public. Think about the Oscar Pistorius case. That case has been going on for, his case went on and on, even I think for a couple of years, actually. So you can imagine in that case, how was the attorney practice being paid by by that individual? So obviously you would have to deposit money in the trust bank account of the attorney, and the attorney would have to, transfer, a payment for in portions for his services, to the client. You would have to transfer the portion on a month-to-month case. So you would not have to necessarily transfer the whole amount at once, okay, since the case was still ongoing, right? So that's one of the other dynamics you need to understand behind the trust bank account and of course the business bank account. Then there's the rest of the other journals which I will deal with when we get to that road. But then of course there is another important topic which you will see, especially when it comes to assignment 3 and 4, which pertains to the bank reconciliation. Bank reconciliation. Now they love this concept quite a lot, and there are summaries that I've made for you with regards to this topic. So it will be one of the most simplified topics and one of the most interesting topics to do in this module. Right. Then topic number 6, it deals with ledger accounts. Right. So like what you noticed earlier as I was giving you an outline from topic 4, books of prime entry. What is happening there? You are recording transactions in those books. But at the end of the day, the accounting process operates in such a way that once you've captured certain transactions, in your books, which is your books of prime entry there, you need to transfer the totals to what we call ledger accounts. And that's why there's topic 6 dealing with ledger accounts and the trial balance. You will get questions concerning ledger accounts and trial balance, but mostly in assignment 4 there, right? And then, of course, okay, so that for you to understand this better, you need to also get to have a good understanding of, of the accounting process itself. How does the accounting process really operate? So it starts with source documents. And from the source document, that's where we get information that we will use to capture the transactions in our books of prime entry, which is subsidiary journals. From the journals, that's where we take the totals and we transfer those totals to our general ledger accounts, which is what you'll be dealing with in topic 6. From the general ledger accounts, we close off the different individual ledger accounts, and then we send those balances or summaries in what we call a trial balance. So a trial balance is just basically a summary of different general ledger accounts in one document. That's what a trial balance is. It's just a summary of the different general ledger accounts in one document, right? And from that document, we will be able to then draft our annual financial statement, right? But in this context of this module, we don't deal with financial statements, but you need to know, what they are just for background purposes. So financial statements, that's what the users are mostly interested in. So there are different types of financial statements, but I'll talk more about them when I introduce you to the concept of topic number 2, right? But financial statements, these ones are done annually, so they are called annual financial statements, right? Then, of course, there's topic number 7. Topic number 7, it deals with transfer of trust monies. Transfer of trust monies, right? So with the transfer of trust monies, here's what happens. Like I had explained earlier, to say you in actual practice would have to have 2 bank accounts. One is a business account, and then the other one it's a trust account. So the trust account, what you're dealing with there, you're only accounting for clients' money. So the money there, it's not your money, it's money that belongs to your client, right? But from that money that is within the trust funds, it's also where you'll be able to pay yourself for your services to the client. And during that process of paying yourself for the services to the client, that's where the transfer of trust monies would have to take place. It's not only because you are paying yourself for the services offered to the client, where you do the transfer of trust monies from the trust account to the business account. But also another thing that causes the transfer of trust monies, it's a case where a client approaches you and they want you to perform a certain service on their behalf, but then they might not necessarily have the money available immediately for you to begin with their case, right? So what happens if you enter consensus with a client, you may use your own money as a business practice, all right, or as an attorney practice. So that money, obviously, if you use your own money, it will be coming from your business account now. So what happens is you transfer that money from your business account to the trust account, so that you begin to perform the expenses or transactions on behalf of the clients. Or you can just even pay it off direct from the business account, and you're paying off maybe the sheriff fees, stuff like that. And any other related expense that might be associated with the case of a client. Right. So you might pay it off directly from your business account and not necessarily from the trust account per se, right? So when that happens, there will be need for us to, to effect certain transfers of trust funds to the business account, where you now reimburse yourself for the expenses that you had paid on behalf of the client. So those are some of the dynamics which we'll be dealing with when we get to topic number 7. Topic number 8, it deals with trust investments. Trust investments. So there's what we call such a thing that we call trust investments in the context of us as an attorney practice, performing. When we're being custodians of clients' money. So what happens is you get a case where a client wants to acquire a property, maybe say 3 months from now, and they already have the money available with them right now, but they only want to buy the property in 3 months' time. So what happens is they'll deposit the money to your trust account as an attorney. Now, when that money gets into your account, trust account, right? If you're a smart attorney, right, what you do, you invest the money, but you don't invest the money just at your own discretion. Sometimes you have to enter an agreement with the client to say, look, since you want to invest, you want to buy the property 3 months from now, why don't we invest your money in a trust investment account for a period of that 3 months? And by the time when you want to buy the property, you would have actually accumulated some interest from that investment, right? So when we enter such agreements with clients and we invest their money, right? So what we call such investments, we call them trust investments. There's three groups rather of trust investments in that regard, based of course on Section 86 and Section 78 of the Attorney Practice Act. So, but we're going to deal with that in detail when we get to that topic. But you need to remember that there are 3 types of trust investments of note. I've already summarized them for you, so I'm going to be discussing them when we get to that. Right. I think I've got that summary with me somewhere. I'm going to open it just so that you can see it. So in topic 8, right? These are the 3 trust investments that I was referring to, right? So remember, from the outline of topics, I was talking about the basic outline of the module, right? So in topic 8, trust investments, like I mentioned, there are 3 types of trust investments. So for almost every one of these topics, there are notes that I have prepared for you in regards to each one of them, so that at least you've got an understanding what is going on there. Then, of course, one of the last topics that you need to know in this module, it's called correspondence, right? So they deal with correspondency. So with correspondency, just so that you understand the dynamics behind it, there's 3 parties to it, where number 1, you've got a client who approaches, all right, an instructing attorney. All right, so the client approaches an instructing attorney to perform a service on their behalf. But then under normal circumstances, it could be a case where, let me give you a practical scenario. So where correspondency comes into the picture, it's in a case scenario whereby you as an attorney practice, let's say you've got your practice in Pretoria, and then a client approaches you in Pretoria, but with regard to a service or a case that needs to be performed in Durban. So maybe say the case that they want addressed is supposed to be addressed in Durban. So you as an attorney practice in Pretoria, you don't have maybe offices in Durban, but your offices are established in Pretoria. What do you do when you get such a scenario like that? And the service has to be done. So what you do, you're the one that has been approached by the client. We call you, or that particular attorney is regarded as an instructing attorney. Why am I saying it's an instructing attorney? Because what would happen is you would then approach a separate attorney that has got offices in Durban. And what would happen is they'll enter an agreement with the attorney who is having offices in Durban to perform the service on behalf of the client. So the one that is in Durban will be instructed by the attorney in Pretoria to perform a service on behalf of the client. However, in the books of the one that is in Durban, guess who is the client? The client is the one that is actually the attorney in Pretoria. So there is no affiliation between this fellow, the instructed attorney, and the client per se, right? So yeah, but anyway, I'll explain those dynamics in details when we get there. But I just wanted you to understand, when you're dealing with correspondence, there are 3 parties involved. One is the client that needs the service to be done. And what would happen? They'll approach a particular attorney to perform the service on their behalf, but the service that the client once offered, it will be maybe it will be offered in a separate location where this instructing attorney does not have offices there. So what would happen? This instructing attorney would instruct the instructed attorney elsewhere to perform the service on their behalf, right? So there are records that has to be done, but one key thing you need to note, there's what they call a correspondent account statement that has to be generated. So you need to understand the dynamics behind this, the correspondent account statement. How do we draft one, and what information does it convey? That's what you need to remember, right? So this was just so as to give you the content outline behind behind FAC 1503, so that at least when we begin to navigate through these topics, you have an understanding of what is going on. You're not necessarily in the dark. At least you have got an understanding of how it operates. Just close it behind. Yeah, right. Are we together, leadership? Can you hear me, sir? I don't know if you can, but I just wanted to confirm. Right. No, so I just wanted to make sure that we are on the same page, as we progress further. So what I would like to deal with now, I'm going to be shifting my screen so that I begin to deal with these concepts of note that I want to introduce you to today. So you discover that, like as I had mentioned earlier, topic number 2, which is what I want to deal with today. I don't want to deal with topic 1 really, because it's simple and straightforward. In the sense, it's all theoretical really, so I don't want to dwell too much on that. But if you want, I could take you through it instead of taking you through topic 2 as such. But essentially, this is one of the most simple, topics. But I didn't want to dwell too much on it because it's theory really. And yes, you find questions about it in the assignment, especially assignment 1, right? So they can ask you, for example, maybe before I get to topic 2 per se, before I introduce you to it, what they would ask you, they could ask you something about the definition of accounting. What is accounting? The nature of accounting, forms of ownership and users of financial statements, internal controls. So there are 2 sets. There's what we call built-in internal control measures. Then there's what we call internal control systems and procedures, right? Financial frameworks, they can ask you about that. The financial statements, what are the different financial statements there is? So in your case, all right, you only deal with 2, but there are more than 2 financial statements anyways. There are more than 2. But anyways, for the context of this module, you only need to know these 2: the statement of financial position, statement of profit or loss, and other comprehensive income. Then, of course, you get introduced to the double entry principle. From the double entry principle, that's where the concept behind topic 2 is built upon. Because if you go to topic 2, for example, right, that's where we will be dealing with the double entry system and the different source documents that are used for accounting purposes, right? And then, of course, what is a control account? So they'll be explaining to you what a control account is and and stuff like that. But anyway, these are basic stuff. But I'm thinking now already on a second note that perhaps let me start from here, just so that by the time we get to topic learning or learning unit number 2, at least you have an understanding of what is happening here. So let's start off with the definition of accounting. Definition of accounting. Why do business organizations, perform accounting activities? right? So when it comes to accounting, right, accounting, it's a science on its own, like any other field of fraternity practice, right? It's a science on its own, and it involves three activities, which is outlined for you as follows. So the first activity in accounting as a science, it involves identifying those events that are evidence of economic activities relevant to a particular business or an entity. So that's number one. Number two, it relates to the recording of monetary value of economic events. Okay. And it also involves, so now this is now the third activity that I want you to pick up from there. It also involves the communication of the recorded information to interested users. I'm just highlighting the most important aspects to these activities. So number one, identifying events evident of economic activities pertaining to a particular business or entity. That's number one. Number two, once you have identified, right, those events, number two, what do? You record the monetary value of those economic events. When you're recording the monetary value of those economic events, that is what is attributed as transactions. All right? That is what is attributed to as transactions, right? And from the from the transaction, that's how we are able to draw, information or history about what we call financial activities of the business, right? There is a chronological order that is followed, or a chronological diary of measured events in an orderly and systematic fashion. This means that economic events are also classified and summarized. Yeah, that's where the concept behind elements of financial statements becomes handy, because we need to know, what element is affected in a transaction so that we can correctly classify the events in the financial statement. Three important activities to remember. They can ask you a question about it, so that's why I'm explaining it, right? So they can ask you to say, what are the three activities of accounting? And then they give you some multiple choice somewhere there. And you have to select the correct combination. So number one, identifying economic events. Number two, recording monetary value of those economic events. And then number three, communicating the recorded information to interested users, right? So that's what accounting involves, but it's a science on its own. It's a science on its own, in the sense that it involves those three attributes that I've already explained. So what is the nature of accounting? What is the nature of accounting? When you talk about the nature of accounting, we're talking about, key features, or attributes that seems to suggest that, okay, here, this has to do with accounting related events. So number one, it is a means of communication used to convey specialized information about the finances of an entity. Okay, so what that means is that when we are communicating or conveying information, all right, about the finances of the entity, question would be, okay, what information is conveyed? What information does accounting convey? That's one question one should ask themselves. What information does accounting convey to the user? So number one, it conveys, and because we're only dealing with those two financial statements, number one, it conveys financial position of an entity. And number two, it conveys financial performance of an entity. Right. I'm going to try to to bring into the picture those two financial statements that they want you to know. So the first one, it's the financial, let me just say, statement of financial position, which is abbreviated as SFP. So SFP, I'm simply referring to statement of financial position. And then financial performance is reflected in what I call SPLOCY, which I'm going to show the abbreviation. Which I'm going to break down the abbreviation for you, what it means. So this is the statement of profit or loss. Profit or loss and other comprehensive income. That's what it means. SPLOCI. SPLOCI like this. Statement of profit or loss and other comprehensive income. So when I look at that financial statement, my brother, what it conveys financial performance. How is the company performing financially? I go to their statement of profit or loss. Now, two things that are reflected from that statement. Number one, I would identify incomes from this SPLOCI. And number two, I would identify expenses. Now, the differences between an expense and an income, it can give you either a profit or it can reflect a loss. So that's why it's called financial performance. Financial performance to reflect what? To reflect whether the company is profitable or to reflect on whether the company is poorly performing, meaning to say it's actually making a loss, right? So when we are looking at the nature of accounting, these are the things we're interested to figure out. Okay, what is the financial position of this organization? So financial position on the other end, just so that I can also give you some bit of light. With financial position, it's mostly concerned with assets. In fact, that's where the basic accounting equation comes into the picture, which says assets is equals to equity plus liability. Equity plus liabilities, right? So those are the three things that are reflected in the financial position. So when they say, okay, reflect the financial position of an entity, we just simply want to know what assets does this organization own, what value of equity do they have, what value of liabilities do they have. That's all we want to know when we look at the statement of financial position, right? So that is just to give you a bit of insight about the nature of accounting. So let's proceed to the next item, just so that at least you know these things from a high level. Forms of ownership and users of financial statements, right? So like any other business entity you can think of, then, CIPC, for example, when you're registering a company there, all right, there are different forms of business entity that you can establish. So it can range from sole proprietorship or sole traders, partnership, close corporations, companies. There's also trusts and stuff, but it's not really dealt with here because it's not necessary for you to know that for now. But anyways, these are the different forms of business ownership there is. So there's sole traders. Sole traders, it's you as an individual running your own business alone. There's no any other party involved. That's what a sole proprietor is, or a sole trader. Partnership, that's where you've got a group of people. It can be 2 or more, but up to a maximum of 20 people that come together and they formulate a partnership, right? So that's how partnerships are.